Good morning, everybody. Mike Vaki, Princetontrader.com, here for ntmarkets.com with your Wednesday morning pre-market webcast. Okay, S&P 500 E-mini futures daily chart, and what we have seen in the last 24 hours or so was an attempt by the bulls to get over and stay over the middle band that has ultimately failed. Now, whether they make it back over the middle band today or potentially tomorrow remains to be seen, but at this point, middle band is resistance. The bulls gave up the middle band yesterday and then spent basically 2 p.m. to 3 p.m. testing it in the 72, 73, a couple of peaks up at 74 area, really stalled out at 74. That got our room short the mid band. We covered that last night down at 42.75 rather on the break for a nice little 30 handle trade. And it came right down into the floor that we've been discussing, 32.33. Where did it bounce? 33.5. So you have 1, 2, 3 tests at the 32.33 floor, and that's really going to tell us the story with respect to the next week to 2 weeks in the market. If 32.33 holds, and the bulls can find a way to climb back above the weekly pivot, either this week's weekly pivot up at 65.40, or next week's weekly pivot, which will be, certainly, lower, simply based upon how big of a dip we got last night. If they can climb above weekly pivot and continue to establish and maintain 32.33 as a floor, that's something that the bulls can absolutely build on over the next couple of weeks for a move back and above middle band. What I was saying to our subscribers last night was, don't get complacent if you are someone who prefers to be long. Don't think for a minute that these are the bulls of 2013. They're not. The bulls of 2013 are back in 2013. They are not coming over the hill here to save the day. At the same time, these are not the bears of 2008. We are not going to start going down 2% every single day. Not going to happen. Not going to happen. What is much more likely to happen is that the bulls are going to have their time and the bears are going to have their time. It's going to be a much more trader-friendly environment, a much more position trade-friendly environment, which we haven't really seen. Well, we've seen it, but it's only been from the long side. You haven't been able to hold a short position really for anything meaningful, at least the last 2 years. You're seeing a little bit more of a steady, you get swings up, you get swings down. It's a little more predictable. It has its bumps along the way, and it's still far harder to be short than it is to be long. But at the same time, you've got a high here at 21.18. You have a lower high, 21.06, 21.07. And you have what looks like another lower high at 81.75. And the bulls are going to have to counteract that. A break of 32.33 opens up a move to the purple line, the 200-day exponential moving average down at 2001, say 01 to 03 by the time it would get there. That's not unusual, and it's not a break of the overall uptrend, I would argue. We're getting into a more two-sided market. That means you're going to get a lot more reversion to the mean. On my stuff, mean reversion is the 200-day exponential moving average. We got very spoiled from the long side in spending over 400 going on 500 days without interacting with the 200-day exponential moving average. It is not, interacting with the 200-day exponential moving average isn't supposed to be, some annual anomaly. It's something that regularly happens in two-sided markets. So as we see the moving average catch up to price, we're going to interact with it a lot more frequently in 2015 than 2016. And you need to prepare yourself mentally and emotionally for potentially breaking that area and turning it into resistance, which would end the overall uptrend and probably send us into a much more definitive two-sided market. So I'm not here to bestow gloom and doom. We have an excellent floor at 32.33 that could hold. They could break over 81. We could still do new highs. But what I want you to think about is that this is not the easy long that it's been for the last couple of years. And you need to adjust your trading brain to account for this. In the very short term, you need to be smaller. You need to be using stops. It is very volatile. Okay, everybody have a fantastic day. Follow us on Twitter at Princeton Trader. Check out the website, princetontrader.com. Come check out the chat room. Lots of new trials, lots of new members. Come learn with us. We would love to meet you. I'll be back tomorrow morning with another webcast. Trade them well, everybody.